I'm here with Justin Tyler, Director at Daintree Capital. Justin, welcome to the Inside Network's Income and Defensive Symposium 2024.
Thank you, Tahn.
Now, many advisors are looking at inflation and trying to support their clients to generate resilient income across retirement. What advice do you have for them in navigating the current conditions?
Sure. So inflation's been such a big part of markets over the last several years. I think that the higher for longer story, whether it be inflation or interest rates, obviously they're linked. I think that's something people really need to be aware of. And that flows through to asset allocation in a couple of ways. I think the main way is that many bond allocations have a fixed rate component to them. They might follow a Bloomberg benchmark or what have you. And there's an expectation that those sorts of portfolios will perform very well if rates fall, but of course rates may not fall. Right. So I think that to be resilient, you want to be a little bit careful as to how much interest rate risk you have in your portfolio, how much credit risk you have in your portfolio, how much, there are various risks in fixed income. You want to make sure you've got something that's balanced from a risk perspective rather than just, dominated by, say, interest rate risk.
For many years, investors could generate income and achieve a de facto defensive position against their equities at the same time. Do you still see this as being the case?
Well, following on from what I've just said, potentially not. When you think about what's happened to the way that bonds and equities have moved, they've moved together and not in a good way quite often over the last couple of years. You've seen both asset classes selling off at the same time, and that may continue. I think that has its roots in inflation and what people think inflation is going to do going forward. If inflation stays high, there's every likelihood that the next time equities sell off again, we see bonds selling off at the same time. So I think that to be defensive in fixed income, that doesn't mean just buying a whole lot of government bonds anymore. I think, as I said earlier, it just means having a diversified portfolio of fixed income, maybe floating rate income, and various types of credit as well as government bonds.
Yes, uncommon correlation has been quite a theme this year. We've seen rates reset quickly, with many practices adjusting their portfolios to reflect this. Do you see the current pattern as having longevity, or should advisors position themselves for imminent changes to market conditions?
Look, it might definitely have longevity. We've seen, not just from a cyclical perspective, drivers of inflation, but we've seen structural drivers of inflation emerge over the last little while. Things like the costs of the green transition, things like the reorientation of supply chains that in itself that's linked to geopolitical risks. So there are reasons to think that inflation is going to be higher for longer. That means, as I've said, interest rates should be higher for longer as well. And so when thinking about what that means for the future, it means you want to be thinking about, from a portfolio perspective, what does your defensive asset allocation look like, and does it actually reflect what we're likely to see going forward? And as I've said before, that means less interest rate risk and more credit risk, particularly in investment grade, but not necessarily in the higher credit risk part of the spectrum.
And what do you think could be the biggest market surprise as we move towards the back half of 2024?
There's any number of surprises that could happen. Probably the one there's two actually that I'd mention. The first one would be if we see part of the fixed income market that people have a lot of asset allocation to, which is private credit. If we see something lock up in that part of the market, if we see the higher for longer environment starting to put pressure on some of these entities, but of course the transparency in some of these funds is not what it should be. So it'll be a surprise that perhaps something locks up. I'm not necessarily thinking that that'll become systemic, but certainly it's worth watching for, both locally and globally. And the other one is what I've said before. Perhaps we have a situation where risk asset markets sell off and actually government bonds sell off at the same time. I don't think many investors are expecting that to happen.
And finally, what do you see as some of the key takeaways for advisors in relation to when they next speak to their clients?
I think the main one is to think a lot more carefully about what the defensive asset allocation that you have looks like and what role you expect it to play, and actually is it going to play that role going forward. So of course that's a journey, and that's a conversation that advisors need to lead. It's one that fund managers like ourselves are very happy to help with, because we believe that the world's changed, and so it's a somewhat difficult environment, because you have to have a different conversation with your clients going forward versus the conversations that you've had in the last few years.
Wonderful. Justin Tyler, thanks for joining us.
Thank you for your time.